All right, let's dive into SIMPPLE LTD. They're a prop tech company right at the heart of what could be a massive shift in how we manage buildings. And they're trying to answer a pretty fundamental question.
This isn't just a hypothetical anymore. It's becoming a critical issue. The entire facilities management industry is facing this perfect storm, right? You've got an aging workforce, labor costs that are just going through the roof, and this constant pressure to be more and more efficient. The old way of doing things, it's just not cutting it anymore.
So, what's SIMPPLE's answer? It's something they call the Autonomic Intelligence Engine, or AIE for short. You can think of this as the central brain. It's the core piece of tech designed to create buildings that are truly autonomous, facilities that can pretty much run themselves. Okay, that's the big, ambitious vision. But how does that actually stack up on the balance sheet? Let's take a closer look at their 2025 financial performance. Right off the bat, the headline number is pretty impressive. The company put up 57% year-over-year revenue growth, hitting about $4.5 million. That's a clear signal that the market is buying what they're selling. But that's just the surface. When you dig in, the story gets a whole lot more interesting. And here's where you really see it. Take a look at where that money is coming from. A full 75% of their revenue is now from robotics. That completely overshadows their older, legacy software business. This isn't a small change, it's a major strategic pivot. This table just lays it all out perfectly. You've got two very different stories happening here. The robotics segment, that's their star. It's driving insane growth, up 188%. But look at the margins, just over 40%. On the other side, you've got their legacy software, the cash cow. It's shrinking, down 34%. But wow, look at those gross margins, almost 77%. But there's a catch, right? This big strategic push into lower margin hardware comes at a price. The company posted a net loss of $3.2 million. It is the absolute textbook definition of a growth versus profitability dilemma, and we're seeing it play out in real time. So, to really understand this pivot and why they're willing to burn cash for growth, we have to look under the hood at the technology itself, because this integrated ecosystem is what really creates their competitive advantage. The whole system basically works in three layers. First, you have data intake. It's using all these IoT, or Internet of Things sensors, to get a live, real-time picture of everything happening in the building. All that data then gets fed up to the AI brain for processing. And then that brain automatically sends out the workforce, whether it's robots or people, to get the job done. Now here's the secret sauce, the real game changer. The platform is brand agnostic. What does that mean? It means, unlike competitors who try to lock you into their specific hardware, SIMPPLE software can control robots from all different companies. For a client, that's a massive deal. It gives them flexibility and avoids getting locked into one vendor. And if you want to see this strategy in action, just look at their Gemini robot. This is brilliant. They take a standard, off-the-shelf cleaning robot, a commodity really, and they bolt on their own proprietary high-margin smart module on top. And just like that, a simple floor scrubber becomes a 3-in-1 machine that does cleaning, security, and acts as a concierge. And that's what makes them different. See, the old software, it just manages people. It's reactive. SIMPPLE's ecosystem manages both humans and a fleet of robots, all working together autonomously. This deep integration creates a really powerful competitive moat. The switching costs for a customer to leave are incredibly high. Okay, the tech is impressive, no doubt, but it's not all smooth sailing. The company is facing some very real operational, financial, and even governance headwinds that any potential investor really needs to understand. First up, supply chain risk, and it is a big one. Almost 60% of their hardware costs are tied up with just 2 manufacturers in China. Any kind of disruption there, whether it's geopolitical, financial, you name it, could cause a major problem for their operations. And that risk is compounded by a dependency on a single supplier, NVIDIA, for their crucial AI chips. Plus, you have the financial pressures. They're burning through cash to grow, and they've had to use some very high-interest, short-term debt to fund it all. We're talking rates of 1% to 3% per month. That's incredibly expensive money. On top of all that, you've got some potential governance red flags. The company relies very heavily on a single related entity, WIS Holdings, for a significant chunk of its revenue and for loans. You combine that with a very recent resignation of its CEO, and it points to a period of turbulence and maybe some strategic realignment happening at the very top. So what's the plan to navigate all these challenges? Well, it's pretty audacious. They're going for aggressive, full-throttle global expansion, targeting North America, Europe, and the rest of Asia-Pacific all at once. And this really leaves us with the critical question. For a company that's already dealing with operational and financial pressures at home, is this kind of rapid global scaling the answer? Or is it just going to pour fuel on the fire and amplify those execution risks? That is the multi-million-dollar question for Simple's future. To really dig into the numbers and explore our full risk assessment, you can download the complete in-depth report on Simple LTD over at HDIN Research.